Well, good evening, ladies and gentlemen, and thank you for being with me this evening. It's good morning to our friends on the east coast of Australia, and good afternoon to our Kiwi mates across the ditch, of whom we have quite a few. Can you hear me all right, folks? Would somebody please just type in the question box that you can hear all right? No one yet. Yes, Mark, of course. Thank you, Mark. the man who can't stop working. He's been trying to retire for years, and he's such a good operator. He just keeps getting these amazing offers, and he really wants to just retire and trade. Good to have you with us, Mark. Well, we've got a whole lot of our friends with us today. Thank you for being with us, and yeah, Graham across the ditch there. Graham, I hope your hand's healing. Hank down in the Hunter Valley. I've been talking to your son a bit, Hank, but good to know that you're still with us. Harold up in Redding, California, very important man, delightful gentleman who was so kind to me when I was doing a webinar, a tutorial over there some years ago now. Made everything great. Harold, you're going to blow your mind away when you see what I've got for you today. And I really do mean that. Jeff Connell, good to have you with us. Jeff, you're going to be amazed with this. George is with us, of course. And let's see who else. We are all our good friends here with us here. Jeff Sherburne. Jeff is a long-time member of ours, and he's very interested in some of the technical stuff I do, which I'm going to show you today. Some stuff you haven't seen before. Joe's with us. Good to have you with us. Joel Goldman from Vero Beach. Good to have you with us, Joel. Louis or Louise? Louis, I guess. Louis. Yes, Louis, welcome. Good to have you. Mark L, of course. Mick D, over there, not far away from where I am. Good to have you with us, mate. The Murph, of course. We couldn't possibly start anything without the Murph being with us. And that's great. Nathan's here. Noel's here. Peter Mack, who's not a short-term trader, another few Peters. Sean down in Adelaide, good to have you there. Trevor Kent, of course, always delighted to have you with us. Trevor's a real stalwart of the Danielcode. And Vicky, we don't have many ladies. You probably get tired of me saying this, but we'd like more, but it's great to have you. Okay, folks, well, this stuff today, stay with it as far as you can. If it gets too heavy, don't be concerned. A lot of this is stuff that I'm doing every day behind the scenes. To me, it's bread and butter. To you, some of this will be quite strange. And I want you to think about it, because what I'm showing you is some of the things that you can do with charts in trading that you're just not aware of, or no one's ever said it can be done. So let's have a look at that and move along here. So here we are. You know that markets are rational, orderly, and sometimes predictable. Well, our main market that we're going to talk about today is the S&P, because we've had that stunning rally. Believe it or not, this whole recent rally that we've had is 59% of the total drawdown from the all-time high in January. And was a big move, and Zero Hedges called it the most hated rally because the hedge funds all missed it. And of course, so they hate it. Well, you have to understand what actually happens in hedge funds compared to the PR version. Hedge fund managers are largely salesmen. They're usually good-looking guys. They're very pleasant, very affable. Their job's to get the money in. Once the money's in, they have a very small group of really heavy institutions that are advising them. Goldman's, JP Morgan, Nomura, that sort of level. And you've got a fairly large community being advised by a very small group. And this leads to what they call the hedge fund hotel. And the hedge fund hotel is the list of stocks that these small limited group have recommended, and the hedge funds all finish up pretty much in the same markets. And when they miss something, like they missed the low, and I don't know how you could have missed it when you've seen what I'm going to show you today, go and scratch your head and say, find someone else apart from the hedge funds who are supposed to be the smarties who missed the low. I mean, I don't know how you could have missed the low. We can find it. You'll see today. We can. Jimmy, good to have you with us, mate. I see you've just arrived. Grand to have you. Go and find someone else who missed that low, because if you did miss that low, you shouldn't call yourself a trader. I mean, we can find that low 5, maybe 6 different ways, as I'm going to show you. And I mean, oh dear, oh dear, oh dear. I mean, these guys are on, millions and millions of dollars a year. They're the real smart asses of the business, but obviously don't know too much about basic trading. Anyway, let's have a look. Words are cheap. Let me show you. So I want to emphasize a little bit to you that markets are talking to you. I know that's the most outrageous comment you've ever heard, but they are. And they've always been talking to you. But the problem is that until I developed the Danielcode, we simply didn't have the language to understand what they were saying. And the Danielcode is the language of markets. In fact, it's the DNA of markets. And when you use the Danielcode sequencing, the chart will tell you it's a go or a no-go. That's what the market is doing in talking to you. It'd be saying to you, I know these numbers and I'm tracking this sequence. At other times, it'll say, no, not this sequence, try another one. So we basically have a reasonably small number of possible sequences, maybe 3, sometimes 4. The markets will switch between those sequences, but they'll tell you what they're doing if you know what they're saying and if you understand the language. So keep that in mind as we go through today, because we've got a lot of material to show you. But the thing to remember is that Danielcode target recognition is the language of markets. When you get a sequence, and you should be getting a hit on one of your sequences, every 3, sometimes every 4 bars. If it goes more than 4 bars without giving you target recognition, that's the market's way of telling you, no, not this sequence, try another sequence. You'll see what we mean as I move into this. So that's what these markets do. For any sequence, they'll say, I know these numbers, I'm tracking them, or no, not this sequence, try another one. So potentially and theoretically, there's an unlimited number of time and price sequences that run from 0 to infinity. Thankfully, markets are creatures of habit, and they choose the same major sequences almost constantly. So any chart that I look at, as soon as I open that chart, I can tell with probably a 92% probability what the sequences are going to be. Once you go outside those initial series, it can get quite complex. We always find it. It's always there. But sometimes it's a little bit different to what we used to see. And markets love to talk about it. They're real chatterboxes. My grandmother used to call me that. You're such a chatterbox. God bless her. Markets are doing that. So be amazed at what I'm about to show you. So last time we had a detailed look at US T-bonds. So I want to use the S&P E-mini today, really because of this wonderful opportunity that we had trading it when all the hedge funds missed it entirely. It was a bad miss, 688 points to the upside. Big stuff, wasn't it? And why? Why did they all miss it? I mean, it looked simple enough to us, and you all got it. I know you did. So let's have a look at where we're going. So this is the S&P E-mini. I'm using the E-mini because it's the most liquid version. For you guys, Jeff, you raised the point a couple of days ago, does this stuff work on cash or the indices? Yes, it does. It works exactly the same. I'm not going to show you that today because there just isn't sufficient time, but I can assure you if you did the same thing on the index, you'd get exactly the same results, because the index is the cash basis and the futures are just a derivative with a pretty modest variance. So this is the whole era we're going to look at here. We're actually going to start when we look at the front month for September, which is the one that gave us the lows, which is why it's important to us. This is the continuous contract. It actually covers 6 separate futures contracts. It starts in June 2021 and ends up in September 2022. And that contract, our front month now, is pretty close to rollover as well. So what we're interested in is the run down from the January 2022 high, then the June 2022 low, and the subsequent rally from that. And because we're particularly interested in the June low and why the big boys all missed the turn, we'll use the current September 2022 or ES 2022-09 contract for our detailed analysis. So let's have a look at that. Boy, we've got some people coming in, running a bit late. Peter's great. We'll have you with us. That's grand. Lots of people coming in. Here we are. Noel's with us. We know that. Nathan, good to have you with us, of course. Yeah. And Bodhi's with us, my daughter. She's honouring us. She's back from med school for a couple of days, and it's great to see her. A bit of a surprise. She popped up here anyway. Akshay's just with us. That's good. Bill, you as well. Colin, haven't seen you for a long time. Good to have you with us all. Okay, let's move on. So, click the button. Here it is in all its beauty. This is the front month of the S&P E-mini contract. And as you can see, it's sort of like one half of the chart is not there, and the other half of the chart is there. Well, all those little dots you can see, there's not a lot of forward hedging in equities. If you look at this similar sort of front month in a lot of the grains, certainly in the energies, the early parts of the chart are heavily populated. But there's not a lot of intermonth forward calendar spread hedging. There are calendar spreads in this market, but not a lot of volume in it. So you can see you finish up with just those dots. Now, they're really, when you hone in on them, they're actually 2 dots there. What looks like a dot or a scattergram, if you like, is actually an open and close, and pretty much you can see a few of these days have got a bar on them. There's been a few contracts traded, but the vast majority of that time there's just an open and close, and they're exactly the same, and that's what you see at the beginning of this contract. So dots are essentially zero volume, just open and close. And I don't know if any of you have ever thought about it when you start your analysis on the front month, because you should do your analysis on the front month in particular, as well as the continuous chart. But the front month is what you're trading, so that's the one you really want to know about. So you can see almost half the chart, certainly more than a third of the chart, is just those dots, which are zero volume essentially. And so I guess when you look at your charts like that, we just simply ignore that. Now, this is a pretty familiar pattern. On the NASDAQ chart, it's notorious when you go to the front month, I'd roll over in the NASDAQ. I mean, it's just dot, 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 dot. There's just a whole lot of time where there's zero volume, so you just get the 2 dots. I assume it's a real contract. I don't know if somebody at the CME actually trades one contract. I doubt it. It might be a theoretical number. I don't know. I've never actually been able to find out. But here we are. If you said right to the last one, you're wrong. All data points are valid, useful, and some are important. You wouldn't think so, would you? You look at that chart, look at it, have a good look at all those dots. you're just very hard to think that they're of any meaning. And I put a little bracket around June the 10th because that's the day this chart becomes the actual front month. So all the trading before that is in a different contract. Okay, so let's see what happens. So the current front month, the S&P E-mini 2022-09, that's the contract expires in September. That starts on June the 8th, 2021. Long time ago, isn't it? How could that have anything to do with current price movement? Scratch your head about that and have a think. Chart starts on June the 8th, 2021, 13, 14 months ago. How could any of that have any relevance on what price has been doing, and is doing recently, since this month, in fact, became the front month? You can't get your head around that, can you? So the high comes in January 2022, and that's in the March 2022 contract. The major low comes on June 2022, and that's in the September contract. So we're going to use that September contract, even though the time period actually covers 6 separate S&P future charts. And I'm not adjusting for gaps, just what one bare chart gives us. That's called making things really hard. So buckle up and we'll see what the Danielcode's got to tell us. So if you're new to Danielcode, you may not know that the Danielcode cycles are derived from 2 base numbers to which we've applied a bit of basic math. Those numbers both have 5 as a base or as a fractal. I don't know why, maybe you do. I actually do know, but it's a long conversation. But those numbers give us the rule of 8s. That's where the rule of 8s comes from, the 2 numbers that are the base of the Danielcode. We use 2 cycles from the rule of 8s, 5 Danielcode time cycles, and 2 self-selecting cycles that come from the rule on time progressions. Time progresses in a given fashion. So these are pure time cycles, but we use exactly the same cycles switched to ratios to define the Danielcode price levels. So think about that. These are time cycles, so they're moving across the bottom of your chart, the x-axis, and they're vertical lines. How can we then spin that so they become horizontal lines and their price? Now, if you think about that a lot, but it's very hard to accept unless you are steeped in the Danielcode, which proves it every day. And that's probably one of the hardest things for folks to accept, that time and price are the same thing on different axes. And the next hardest thing for folks to accept is that Forex trades exactly the same as futures on the Danielcode. People have a lot of arguments about this, but they do. And if you've been at the Danielcode for a while, you've certainly seen it. So here we are. Have a look at this. We've taken all the dots and we've just added a tool that shows us the gaps. So now we can see that all those dots to the left of the high on your chart as you look at it, they're not just random dots at all. They're creating swings. They're creating swing highs and swing lows. And from the major high, the January 2022 high, in fact, there are 5 identified swings before the high. Okay, so you can count them. I put numbers on them. 1, 2, 3, 4, 5. My guess is you've never thought about these 5 swings, particularly as they are out there in ... land. You probably just ignored them. But they're trying to talk to you. And what they're saying is that we are creating the rest of this chart. So if we start to look at swing 4, we're getting very, very improbable. We're way out there in time because the bulk of the Danielcode ratios are created by 2 or 3 swings closest to the high or closest to the low. But have a look at this. From swing 4, the low of swing 4, to the January high is exactly 50% of the total range of this chart. In other words, the total range from high to low is twice the distance from swing low 4 to the all-time high. Exactly. Exactly. 3637. There's the low. Twice the retracement from swing level 4, the low, to the all-time high. How can that be? These are just dots on a chart. Appear to be totally random. But nothing's random, is it? So when we create time or price levels on our charts, we call them targets. We then require the market to find those targets in a particular way. If the market is rallying, it needs to find its target at the bar high or the close. If the market is pulling back, it needs to find those targets either at the bar low or the close. Those of you who've been with us for a while know that target recognition is very, very specific. It's achieved when the market finds a target accurate to 0.1% variance of the price. No more large variance between the target and the bar high, low, or the close, respectively. And few bars achieve this. Accuracy is essential. Somewhere along the line, when you see a full chart, someone will raise the 500 monkey thesis, which basically says if you lock 500 monkeys in a room with 500 typewriters, this is how old it was, we were still on typewriters back in the day, one of them will write War and Peace, or one of them will write the Bible. There are several versions of it, but basically what it's saying is that if you throw enough random material at any situation, patterns emerge given unlimited time and unlimited power source, which in this case was the monkeys. But that's just ignorance. It's not finding the numbers, it's how it finds them. It's what the market does at those numbers. And you'll see time and time again, the market will get to those numbers and often it'll pull back a little bit so it finds the number on the close. Got to be very, very tight, this 1% variance. I mean, when I started with the Danielcode, the S&P at least was worth less than a third of what it is now. We still use that 1% variance. Now it's got bigger because the market's moved up so much higher. But it's still 0.1%, not 1%, 0.1% variance of the number wherever those markets are trading. It's not finding the numbers, it's how the market finds them. Okay, so that was swing number 4, way out there in the boonies. Swing number 3 also finds the low with a variance of 2 ticks, $25. That's it over this whole market range. And we're talking about this happening many, many months after that low of swing 3. In the same way as the low of swing 4, that was back in March, maybe April, May 21. And that low, and the low in swing 3, is dictating the price action in the current front month. Scary, isn't it? 3637 we got from one version, 3639.50 from the other. That's the low. That's the low of that whole move. Scratching your head? Hope so. So this is actually what happens. Target recognition from the high to the low covers 117 trading days. Only 15 of those bars gave us target recognition within the definition that I've created, which rules whether we have sorry, here, Jeff Do you use graph paper on your charts to draw the charts? No, Jeff, I don't. I did. I started off doing that. I had all these charts about half the size of a door in your house with graph paper on them. Certainly, that's the best way to learn. It's the hand-eye combination that really makes you aware of what markets are doing. And when you're putting your bars on one bar, one little square at a time, you really think about it all. But no, this all comes straight off the Trade Navigator tools, which I've adapted, and the actual tools themselves are useless. They're all Fibonacci this and Fibonacci that. And if you haven't done a tutorial or heard me tell the story, you may not know that Fibonacci ratios are actually a measure of the fecundity of rabbits. Okay, how's that for left field? I'll tell you about it one day. But nothing to do with trading, although lots of people think it is. So in that whole 117-day period from the high down to the low, only 15 of those bars gave us target recognition. The important thing is when you look at some of those clusters, if you can see 3, it doesn't have to be 3 out of 3, 3 out of 4, 5, 6, anything, but 3 in a sequence, looking only at down bars, that's the market talking to you. And what that market is saying, I'll show a more detailed version as we move on, it's saying, I know these numbers and I'm tracking them. When it breaks away from that sequence, as it does, it's saying, not this sequence, try another sequence. And the swing from low 2, which I've shown you, to the high, that's dominantly the other sequence. That's not the active sequence, that's the alternate sequence. Okay, keep looking at this chart. We've got at least 3 other ways of finding that low, and here they are. There are standard Danielcode blue lines. You see them on our members' charts every day, every day, every day. And you get 2 sequences. One is 367450 and the other is 3678. And the 3678, I think, goes right over the close of the closing low, which is in fact the bar before the chart low. So remember to distinguish, we have chart lows, we have closing lows, and we have swing lows, and there's a difference between them. So 3674.50 and 3678 against the closing low, 3680. One of them has only 2 ticks variance. That's valid. That's Danielcode target recognition. 2 ticks variance, and it's drawn from the high. So near the April 2022 high, the price is up around the 4700s. So the allowable variance for target recognition is 4.7 points. Near the lows, as the price has slipped down to 3600, the allowable variance reduces to 3.6 points. So that sounds, to me, it sounds a lot. I'm used to dealing with much smaller variances than that, but these equity markets are huge now. The numbers are big, but as a percentage, it's still 0.1%, and that's never changed. You've been seeing that since the Danielcode website went public in late 2008, and it's still there. It is doing its thing. So have a look at the other swing. Swing 2 is an outlier. Swing 1 is massive for target recognition. Every complex high or low contains part of the matrix which creates the Danielcode numbers. So far, we've just looked at the downside move from the January 2022 high. So to look at the rallies within the 170-day pullback, we have different charts. If you try and look at the downside targets and the rally targets on the same chart, you'll find you'll get confused. Keep them on separate charts. They're very clear, very, very easy to see. That's simply the red lines that are straight out of the Danielcode retracement tool, which some of you have. If you've done a tutorial with me, or you are subscribed to our website Pro, we give you that Danielcode retracement tool. And that's what it does. It picks retracements. It's valid at the bar, high, low, or the close. You can see the first, a lot of retracements. go straight to the high. The next lot of retracements, it's actually the close that's making those measurements there. Both are valid. So let's have a look at this market talking to us. So it's been talking to us all the way through, and it is saying either I know these numbers and I'm tracking them, meaning that this is the operating sequence at the moment, or it's saying not this sequence, try a different sequence. And that's the process all the way down from the high. I've focused on the low here because I want to show you how this sequence goes. You can see that we have the first, I'll get a highlighter here, make sure I can show you this. Spotlight it's called. Here we are, Spotlight. So this bar here, you can see on the close, you've got perfect target recognition against the blue line. And move to the next bar there. I've got the searchlight on the top of the bar. You can see the low of that bar gives you perfect target recognition. Move on, miss the next bar that rallies. Now we go to the final big push down. And you get that close right on 3790, and the other number there is 3683.50. Have a look at that. So you've had 3 down bars that have given you target recognition. That's the market talking to you. It's saying this is the sequence. It is a go, no go. It's either one or the other. If it's not the operating chart, it's the alternate, and there's not many of them. You work it out if you think about this stuff through for a while. So here we go. We've now had our 3 down, all with target recognition. We're really confident this is the right sequence, and then the 4th bar also gives us target recognition right on the close. Okay, that's talking us into the low. This has been going on all the way since the January high. That's how markets talk to you. Either go or no go. Either yes, I know these numbers and I'm tracking them, or no, find another sequence. So this is a little bit different to how your brain would normally work. For most of you, when you see a chart, you say, I've got to find support and resistance. Well, that's not how the Danielcode works. We know without a shadow of doubt that all markets will turn at the Danielcode ratios. The only question is which is the active ratio and which is the alternate ratio. So when using the Danielcode tools, we put on the Danielcode ratios and then we wait to see which one the market will elect and follow. Now we know that for a fact. If you've got any doubt about that, click on the chart archives link at our website and you'll see there's over 49,000 charts there, members charts that I've created for you since late 2008 when the website went public. And you'll be really hard pushed to find a market that's turned anywhere, excuse me, except at the Danielcode numbers. Now what you're seeing here is some different stuff that you haven't seen before. You're seeing some other ratios that I don't show you publicly. These come off my own working charts that I'm looking at to create the TO3 and blue line signals. And these little price levels in italics, you haven't seen those before. They are using a slightly amended application of the tools that create time and price. And let me go back to where I was, and let's move on from there. So there was it talking to us into the lows. This is an alternate view. Have a look where I've got the numbers 1, 2, and then I've got 3 and 4 on the same bar. Those 3 bars down give you perfect target recognition at the close, and also in bar number 3 at the low, which has got, well, it's got 2 numbers on it, 3 and 4, because you get target recognition at the low and you also get perfect target recognition at the close. So Coffee time. It's still Friday morning down under. Excuse me. And so you can see that sequencing. That is how markets talk to you. I've just put them here because these bars are pretty large, pretty dramatic. It's easy to actually see what's happening. But that's actually going on all the time. That's what markets are doing. They're linking together 3 downward moves or 3 upward moves that themselves find target recognition. When you remember that there's only 15 bars that find target recognition in the 117 bars leading into the low, they're rare beasts. But when you find them, that's the market talking to you. And it's more common than you think. So that's what we've got. There, in fact, is a 1, 2, 3. Trying to tell me there's a low, there's the close. I don't know what I've got there. Must have been something of interest. Anyway, just bear in mind that the numbers in italics are numbers that you haven't seen before. They're another application of the tools that we use. But, I mean, we can find that low, the close and the low, in fact, the chart low and the closing low, 5 or 6 different ways. Why would the hedge funds all miss it? Not sure about that. Let's have a look at the rally. This stuff, pretty straightforward. It may look like it's a lot of numbers on it, but I've actually just left on the numbers where we had target recognition. And we've got 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. The last one there with that little diamond on it, that's not for the bar it's sitting on, it's for the bar beforehand. That high, the ultimate high of the rally, gave us target recognition at the bar high and also at the bar close. So that was double target recognition. Is that stronger? Does that mean anything? Something to think about, because look what happens here. Right here you get double target recognition. In here you get, not on this chart, but on the previous chart, you get double target recognition. Is that telling you something? Yes, it is. Just something to think about. It's interesting stuff, isn't it? So you can see that rally, it's proceeded just as you would expect it to do. It's just bouncing off the Danielcode numbers. Again, remember the numbers in italics, you haven't seen those before. They're a slightly different application. I'm doing that on all of my charts. I don't show those numbers to you on the members charts because it just makes it look too busy, and I know for a lot of you say, too many numbers. So I don't put them on. Once you get used to it, it's easy enough, and it's exciting because those numbers go on as soon as the low is formed, and the market tracks it. So essentially, at the close of business on June the 17th this year, all of those rally numbers were on the chart. They went on straight away. And then, to watch the market move its way through them, to find target recognition, to regroup, to pull away a bit, to come again. I mean, it's so exciting. Honestly, it's the part of trading that just thrills me. I jump out of bed in the morning and I really want to see what the markets had to say to me about the previous day's trading. Okay, let's keep moving, folks. This is just a different view of what you've just seen. These charts are not driven by just one set of numbers. You can find these highs and lows 2 or 3 different ways usually. Have again a look at this top bar here, the top bar of the rally high. You get target recognition at the close and target recognition at the high. Is that telling you something? Certainly. You get that down earlier where you get the same thing, the minor high after the first retracement. You get target recognition at the high and the close, and that leads to 1, 2, 3, 4 bars down. What have we had so far from the main high? 3 bars down, a little rally today that's not on this chart. But we had buy signals. We had buy signal few everywhere. Let me see what we had. We had buy in DAX, we had a buy in the Dow, we had a buy in the NASDAQ, we had a buy in the Russell. That's pretty much the lot. What did I miss? Nothing. Maybe the S&P. We had a TO3 buy in the S&P as well. They had the lot. 5 markets, 5 signals, all elected and up. Very interesting. Keep thinking about what this market's done with this massive retracement of 59% of the total run down. Towards the end of this session, I'm going to just show you a snippet from the fourth seal, which I know some of you got very jaundiced about, particularly those who were trying to trade futures against Frank's forecast. But the fourth seal is now taken a position on the S&P that is contrary to every opinion I've seen or heard. It's worth reading it. If it's right, it's very dramatic, and a lot of people are going to be wrong-footed. As well as that, gold, COMEX gold, is in a parlous position on the charts. It needs to hold some of those important lows, or else there can be real trouble in gold, which is a silly thing to be thinking of with the world conflict and gold's assumed status as safe haven, etc., etc. And there it is. Okay, so there's another view. Find the low. Again, you can see that low 2637 straight off the blue lines. There it is. Couldn't have missed it. 5 different ways we've shown you how to get that. Okay, so let's move on. Think about some other things. Your brain should be scrambled by now. UST bonds. This is our long-term chart. Those of you who've been with us, I've been showing you this periodically since late 2008. And we put those Danielcode trading channels on there, and I think they ended in September. I put a blue line on the chart where we stopped carrying that forward. And it's back in 2017, 6 years ago. Since then, the market has tracked the Danielcode trading channel to its high and its low. Remember, this is a very long-term chart. Each of these bars is built from 24 separate trading days. And last time I showed you this, we talked about the reality that it was going to break the third standard deviation from the mean to the downside, which it hasn't done since 2000 at least. All of this chart has run within the 3 standard deviations to the upside and the downside. And I told you it looked like it was going to break. It actually had a number on there where we thought it would go to. It wasn't far off. But have a look at this chart. It's hanging around. It's trying to find support on that third standard deviation, which is already broken. If this market goes down and takes out that low, the next level is down on the 4th standard deviation, which is down around 125.10 or thereabouts. It's a big move, and that will cause some fur to fly. So far, I keep saying, all of the moves in the equities markets have been gentle, they've been benign, there's been no violence. You would expect there to be some violence on a move like we're in at the moment, and as we were going into the lows. Everyone was short, everyone was bearish, everyone was so bearish, particularly the hedge funds, they wouldn't buy that low. 59% of the total range that market rallied. None of them were on it, but you were on it. That's the main thing. Okay, let's restore a bit of our sanity now. Just run through some of our wonderful TO3 and TO3 plus signals that are busy there making money all the time. This is Aussie US dollars having a bit of a rally. Looks like it's got further to go. This is dollar CAD, Canadian, what's called the loonie, USD Canadian dollar. The loonie, which is not a comment on Canadians, of whom we have many as members. That's their national bird, the loonie. Nice little TO3 and blue line sell signal, and we've got a few bars down in that. Next, US dollar index. This has been pretty interesting. We had a 6S buy signal right at the low. Then we had a 1 bar counter trend sell, And you should know by now we had a flip me buy to get us long again back into the high, which set up a TO3 sell signal, which was elected the next day. And that's been a nice little rally. And the US dollar is just been very, very strong, hasn't it? It's really done really well. So this is our normal members chart of the S&P E-mini, which has got much, much less information on it. It's got everything you need to know. And you can see we had a TO3 and blue line sell signal right at the high of the big rally up from the June low. And we had that sell signal was elected. We've got 1, 2, 3, 4, 5 days, 5.5 days down, straight into a blue line at 41.09, which triggered a TO3 buy signal. Off it goes. Bang, bang, straight up, running into resistance now. 42.03, we're just sitting on that chart, and that's pretty much where today's high was. This is gold. TO3 sell signal right at the high on the blue line at 1824.9. A run down, very subdued, and look at the rally. It's really struggling, isn't it? You look at the close, it's not making a lot of 3 days up, little moves up. Next day, open and close, much the same place. Little bar up today, but pushed way off the highs. Could be some trouble in this market if it doesn't start holding some of those important lows. Here's the Russell, which I recommend to anyone who's trading equities. It's really much better. It's been our go-to equity market for all year at least. It's been very, very good with its signals. TO3 signal right at the high, TO3 buy right at the low, closed exactly on the black line, 1918.3. Off it's gone, rallied 2 days, very nice. If you're having trouble trading the S&P or the NASDAQ, have a think about the Russell 2000. It's a very rational market. There we are. So T-bonds, this is the daily T-bonds. We've been trading that pretty actively. We had a TO3 sell signal that got us short on the outside bar. And we went down, we had a buy signal. We had a success sell signal right at its high. Down it's gone since then. And for today, we had a blue line buy signal. Now, those of you who've been following us for a while will know that we use a 2-bar buffer on our futures charts. That's not really Danielcode theory, that's a Needhamism. I just got sick of getting filled one tick above or below the true high or true low, so I extended it to 2 ticks, and I've been doing that for so long now, it's just become part of the makeup. But this actually took out the high today, but only by 1 tick, so we were not pulled into the trade, we were not elected. But there was the trade, the blue line trade. You can see why it's set up with the close right on that blue line at 136 correct 15. That little arrowhead that you see is called correct, and that's actually telling you that the price is derived from the rule of eighths. And CBOT, which has merged with the CME, but their particular charts, mainly grains and interest instruments, they use that methodology. So I just think a little bit about the fourth seal, because the comment we have running on equities is totally different to any other comment I've heard. It's really a one out, and you should read it. It's really been very interesting. As well as that, Frank DB is saying gold has got to hold some points that he sets out in the commentary of gold. Otherwise, it's potentially in big trouble. So there we are. So that's pretty much us for today, folks. If you would like to learn any of this stuff that you've seen here, I'm happy to teach that to you in a tutorial. We've come out with a new document and a new price schedule, make it possible for more people to learn to trade the Danielcode with me, and it's all one-on-one with me. And remember, the business of trading is making money. We talk a lot about the theory of things. I talk about showing you how amazing these charts and markets are, but still the basic business is the business of trading. It's about making money. If you haven't already, folks, you're most welcome to have a free trial. Go to www.thedanielcode.com, start your free trial, just hit the register button. Any issues, contact Terry at support@thedanielcode.com. If you've had a free trial previously, the website will probably remember you and not want to give you another one, but contact Terry. He'll fix that for you straight away. Here we are, and of course, our disclaimer. I do urge you to take these disclaimers really seriously. It's very, very easy to lose money trading futures or Forex if you don't know what you're doing. In the same way, it's equally easy to make a whole lot of money trading futures and Forex once you know what you're doing. And learning the Daniel Code is the most important thing you can do for your trading career. So that's us for the moment, guys. Here's Akshay, Thirst for Knowledge. John, your thirst for knowledge. Amazing. Yes, I would put many young man to shame. Keep up the good work. God bless. Okay, thanks. Thank you, Jeff. You enjoyed that. And Murph as well. Yeah, Bloody Mary time now, Murph. You know that, don't you? It's almost 11:30 on Friday morning here. So I've put my orders on. That's me done for the day. And thank you for a brilliant webinar, says Catbo. And Hank as well. Glad you enjoyed it, guys. Certainly plenty to think about, isn't it? Don't be frightened. This will be posted in 24 hours. Don't be frightened to go back to the video when it's posted and go over that again. Put it on your own charts. See if you can make sense of it all, because it's real. It's really real. It's scary real, and it's quite wonderful. Thank you for that, Vicky. Vicky's enjoying it. Wonderful to have you with us, Vicky. I'm so glad you're enjoying it. Thank you for taking the time to post. That's most kind of you. And Jimmy enjoyed it. And Martin enjoyed it. Thank you, Martin. And Rolf down in Melbourne. Training, baby. Yeah, it's all about training, isn't it? Okay, that's me for this week, folks. All the best. Have a wonderful weekend. I'm a little further involved down the week than you are on Friday morning. Most of you are still Thursday evening, but the trading's been quite wonderful. It will continue to be that way with the Daniel Code. And thank you for being with me today. I very much appreciate you coming and attending these webinars that I have so much fun putting together for you. All the best for now, and bye-bye.